The Bank of Canada announced a cautious hold at this morning's policy meeting. They've held the overnight lending rate at 2.75%, which translates into a prime rate holding at 4.95%. What drove them to take a wait and see approach? One word: uncertainty, especially around the tariffs and global trade tensions. And all this uncertainty is putting pressure on the economy. We have slower growth, cautious consumers, and growing unemployment. And inflation is still a factor. It's being pulled in both directions due to lowering oil prices, and that's being counterbalanced by all the disruptions from the trade war. But today's Bank of Canada interest rate decision is not the most interesting or important thing happening in the world of interest rates. There's a much bigger story in the bonds market, and if you'll indulge me for just a few minutes, I'll try and explain exactly what's going on and why it's important to you and mortgage interest rates. Last week, we got a flash of extreme danger from the bond market, indicating that something is at risk of breaking. This is the chart of the US 10-year bond weekly change in basis points. Basically, it shows by how much the bond yield moves per week. And you can see that last week we had a 50 basis point increase. That is not normal. That's only happened 2 other times since 1990, and it's a sign that the market is stressed and something is about to break. Remember that the bond yield and the bond price have an inverse relationship. So if the bond yield has spiked by 0.5%, that means that there was a sudden crash to bond prices. And an extreme crash to bond prices like we saw last week is something that is completely unexpected from the market, because typically when we have volatility like we had last week in equity markets, money flows to the safest place, and US government bonds is considered to be a safe place to put money. So the inversion of that is something surprising and tells us that the market is really broken. There are 2 theories as to why this is happening. Number 1 is the theory of the bond vigilante, which sounds exciting and grabs headlines. Got your attention now. And number 2 is maybe a little less exciting and perhaps more in line with reality, and that is liquidity requirements for large investors. So let me explain both. A bond vigilante is a bond market investor who protests against monetary or fiscal policies considered to be inflationary by selling bonds, which increases yield or the interest rate. And with Trump's tariffs, the market has had a lot to protest recently. And the thing you have to understand is that the bond vigilantes in this case are Trump's adversaries, like China or Japan or the rest of the world who Trump has waged this trade war against, who hold close to $8 trillion of US debt through bonds and treasuries. So there's this theory that came out last week that this group began to flex their collective muscle by selling their bonds at below market prices, which has the impact, of course, of driving up the bond yield, effectively making it more expensive for the US to borrow money. Checkmate China on the US in the trade war. But the second theory, and perhaps the more likely reason, is that the extreme volatility in the markets, the selling off of markets, required big money. Think billion-dollar pension funds to come up with cash quickly. Effectively, we call that a margin call. So they leverage when markets go down, they need to cover their positions, they need cash. Where do billion-dollar pension funds hold rainy day money? Generally in US government bonds. And if everyone rushes to sell at once on the same day, then you get this sudden drop in price like we saw last week. Now, why does this matter so much? In 2025, the United States government has to refinance a whopping $9 trillion. That's about 25% of their $36 trillion of debt. And they don't have enough income to cover the interest payments. The US government is teetering on the brink of becoming insolvent. And so this is a matter of survival for the US to keep interest rates low. And it's for this reason that the lowly bond could do what no other nation, government, diplomacy could do to win this trade war or change the tide of the trade war that Trump is hell-bent on inflicting on the world. So the bond market did just that.
The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful.
And that brings us back to Canadian mortgage interest rates. Up until last week, the overall expectation was that the weight of tariffs would weigh down the Canadian economy, unemployment would rise, we'd have lower GDP, Ultimately, the expectation was that inflation would eventually come down and that would bring interest rates lower. But with that incredible spike to bond yields, which we also saw to the Canadian bond yield, because the Canadian bond yield tracks the US almost like for like, fixed rate mortgages in Canada actually unexpectedly increased. And this highlights the difficulty when it comes to giving advice around mortgage interest rates at the moment. Fixed versus variable, it's an age-old question. For some, the volatility is enough to warrant the decision to go with a fixed rate mortgage, get off the ride, lock it in, and not have to deal or worry with the extreme swings that we're seeing. For others, the view from 10,000 feet is still that the Canadian and global economy will suffer, and with a suffering economy, overall interest rates should trend lower. But it's definitely not a straight line to get there, as this week has proven. Now, unfortunately, I'm not able to give you that silver bullet to tell you exactly what to do, because it really depends on a case-by-case basis. But what I can offer to you is a sounding board. So feel free to book a call with me and we can discuss what the implication of interest rates are on your household and what the right decision is for you. Until next time, bye for now.